Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow Chicagoland Retirement with Tim Stearns, CFP, Chicagoland's certified financial planning professional. And if you've got questions or concerns about your money in this market, in this economy, who doesn't? Well, Tim Stearns is your resource, ladies and gentlemen, helping to uncomplicate the financial world and making sure that every dollar is working its hardest to help you achieve your financial goals. Tim, we always appreciate your insight and guidance here on the program, an educational approach to our money here on the show with the opportunity to get further information in the classes and the sessions that you hold, as well as the individual planning that you offer to your clients and those savers and investors who are concerned about their money. And I'm sure you're getting a lot of calls right now about that.
Well, as April ended, a lot of people are very nervous, and we're getting a lot of phone calls. People who thought they were diversified weren't. Those who thought they were taking less risk were not. There's a lot of things going on that people, I think we became enamored with a bull market that was about 13 years long. And we forget the 2008s, the 2000 through 2002, where people lost 50%. This is the realities that we deal with. We need to make sure that people understand that they should have some things that are uncorrelated to the market. Greed can kill you. And when we get greedy, we get stupid with our money. And I remember my professor at DePaul said, bull markets die on euphoria. And where were we at the end of 2021? Mm-hmm. Euphoric. The market was just going to keep going up and up and up. And now things have really come home to roost. All the stimulus stuff that we've done, the Fed's trying to act to stymie some of this inflation. So things are changing, like by the minute. So I would tell people, give us a call. Let's take a look at what you have, and we can salvage some of that and make a better plan.
You mentioned 2008. April ended actually the worst month in one of the market indices, in particular, the NASDAQ, the worst month since 2008. Now, many of the NASDAQ kind of tech stocks, Tim, were the ones that led the charge and the boom, especially post-COVID. But everything being cyclical, things do tend to turn around, and there's a lot in the market and the economy that is turning around right now, but it does have savers and investors worried. Now, over the long term, Tim, we're still well beyond where we were 5, 10, 15 years ago. However, just a little bit of volatility for those who are overexposed to risk or maybe have not seen volatility in quite some time can be unnerving. And specifically with the exposure to the markets in our portfolio, Tim, what do we need to know and understand when we do see the tide turn and things go the other direction?
I will tell you this, Peter, the people that have done an income allocation plan with me that know where their bills are being paid and that type of thing, they aren't calling us with worries because they know that the growth bucket is going to have volatility, right? But the uncorrelated assets, maybe it's an annuity, maybe it's a bond fund that's pretty safe, literally called a conservative allocation. They know that those are where they're getting their monthly money for their payments of all their bills. So they're not overly concerned. They're not happy with what's going on in the market, but they also know that they have a plan. And I think if I didn't have a plan right now, I'd be very nervous.
Well, most people, Tim, have tools. They have the access to certain investments, whether it be the set menu inside of a 401k or the spectrum of the financial world inside some type of IRA or brokerage account. But simply having tools doesn't constitute the kind of plan that you are talking about, right, Tim?
Right. I mean, you have to have a plan, and most people don't. They are winging it, and they thought, oh, well, I'll buy some Apple. Nothing's ever going to go wrong there. I'll buy some Amazon. Nothing ever goes wrong there. The problem is that with, all these things are correlated to the markets, and the Fed raising interest rates kills a technology company, because what do they do a lot of times? They borrow money, and now their cost of borrowing is more expensive. Therefore, it's going to affect the stock. And you have to kind of connect the dots a little bit, but it makes sense when you see that.
Well, if you've got questions or concerns about recent market volatility and its impact and effect on your portfolio, then you need to get a better understanding of what it is that you own, how you are allocated, how each dollar is working its hardest, its best toward helping you achieve your important financial goals. And that's exactly what a certified financial planning professional like Tim Stearns, CFP, can help you get a better grip and understanding on. And if you'd like to speak with Tim, if you'd like to attend one of his upcoming classes, educational opportunities, the retirement rescue, or the individual review and strategy session with your portfolio specifics being discussed with a CFP, pick up the phone and give a call, 800-640-2256. That's 800-640-2256. Tim, being invested, though, we have to understand that there will be good times. There will also be some challenges and some headwinds from time to time. Historically, the market has not only always come back, it has always surpassed previous downturns. But it's what we do in the midst of that downturn really that can impact our outcome and determine what happens with our money.
Exactly. And so I think that invokes what we like around here, which are stop losses. And what the stop losses do is literally try to stop the pain, from losing in a portfolio. We a lot of times have money managers call on us. And, I went through a couple of the things that this one money manager had done in January through March. And what I found was that he had underperformed just based on the market. He said, well, you just got to wait a little bit longer, that type of mantra. Well, I've been hearing that for 27 years. I've been in the industry. I'm done with that. I don't want to wait. I want to have my cake and eat it too, or as my son used to say, my cake and ice cream too. But the bottom line is I want to be able to stop the losses and mitigate my clients and myself personally getting to a good return is the end of the day, and I don't want to go down the stairs to have to come back up the stairs to maybe go one step up. 2 steps back and 1 step up does not interest me as a money manager. That's what mutual funds are for.
You mentioned returns there, Tim, and I think that a lot of investors have been told, have been taught, we hear it discussed and out there that we should have this expectation of 10 to 12% returns in the market. Yeah. At its core, is that expectation fair? Is it justified? Is that a realistic expectation?
I don't think it is. As you and I have talked about, if you look at 2000 through the 2021, the market only did about 5.8% in the S&P 500. So saying to someone that you're going to get 10 to 12% at a clip is insane to me. We don't ever say that. The Department of Labor, when you're doing an income allocation plan, says to use 5% as aggressive, 4% as moderate, and 3% as a conservative approach to what your money is going to garner you in retirement. We'd rather underpromise, overperform. And a lot of these advisors that we see, these illustrations that are just unreal, where they're just going to go up 10 to 12% over the years, you're counting on something that's not a guarantee. And that's, what do you do when you find out when you're 80 years old that was completely erroneous and wrong?
Yeah. And unfortunately, so much time has passed, and that's the realization I think that people are waking up to. And we've seen a fantastic decade plus, the last 10 to 12 years, really since 2009, have been a historic bull market run, in many ways supported by the Fed's direction, by government intervention, by stimulus, by coronavirus dollars being thrown into the economy, and, by the way, sent to each of our personal mailboxes. But Tim, if you look at that cumulative compound average annual rate of return of the S&P from January 1st of 2000 to December 31st of 2021, 5.8%, actually just slightly under 5.8%, 5.78%. If we have the expectation that over that time we would have made or should have made 10 or 12% rate of return. How far off does that put our trajectory for not basing our expectation in reality and on realistic expectations and on what actually has occurred during that period of time?
Well, let's go one step further. If I'm doing that 2000 through 2021 and I'm retired, those effects of only earning 5.8% when I'm supposed to be getting 10 to 12%, and I'm taking money out and down areas and that type of thing, it's going to be, it could be a debacle for your retirement where you're not getting what you thought you were going to have. You know, you see people looking into reverse mortgages because of stuff like that, which is not anyone's goal, but that's a thing. So you need to make sure that you understand what you're doing to yourself by hitching a ride on this 10 to 12%, which I think is insane.
And Tim, you've been here on the radio across Chicagoland talking about the importance and the value of income allocation for 5 years on the radio, for even longer than that in your office as you are constructing the blueprint and the plan for your clients. But is a time like this really, in your mind, emphasizing even further the importance and the value of having that income allocation component?
Yes, because you know where your bills are being paid from. There's money allocated for paying bills. The rest of it, you know, it can take a hit and that type of thing. Maybe you don't, depending on what you have set up, you don't go to that trip that you always wanted to do or do something nice for your grandkids or what have you. But you do know that your bills are being paid, and that's what counts. You know, the other stuff is gravy, and, you know, it can be used for those types of things. The other thing is, you know, to make sure that you have long-term care type hybrid insurance in there, because those are also things that can drag your whole retirement down. If God forbid you get sick and you can't do two of your activities of daily living, and then you're having to draw off of your growth bucket that is down as well, I mean, that's a terrible triumvirate of bad luck.
Again, we are talking with Tim Stearns, CFP. If you've got questions or concerns, if you would like a one-on-one individual portfolio review with a certified financial planner, pick up the phone and give a call to TJ Stearns, Inc. Request that in-person strategy review, that protect and grow plan, that forensic financial analysis, the risk analysis, looking at all aspects of your financial picture, bringing it together into a true plan. 800-640-2256 for that complimentary opportunity to sit down and review your dollars and how each and every one of them is working toward helping you achieve your financial goals into the future. Again, that number, no cost, no obligation, financial review and analysis, strategy session, planning for your financial future. 800-640-2256. 800-640-2256. That's 800-640-2256. And if you'd like to start with a beginning understanding of what income allocation is, why Tim Stearns has been talking to Chicagoland area savers and investors on the radio for 5 years about the importance of income allocation, even longer in person, why prudent advisors have been teaching retirement-minded clients about the value of income allocation across the country for about 10 years here, and what it means to address today's retirement's biggest risks. If you have over $500,000 saved for retirement and are one of the first 10 callers to the program, Tim will provide you with a copy of the book, Income Allocation. It is the essential retirement planning strategy guidebook, and it addresses exactly times like this and how we need to plan proactively and differently than some of the traditional financial models. If you would like that book, Income Allocation, pick up the phone right now and give a call, 800-640-2256. That's 800-640-2256. You can also go online, by the way, tjstearns.com, and there's an opportunity there, not only for lots of additional resources, information, education, reports, and videos, previous editions of the radio program. You can go back and listen to Tim Stearns talking about this well before we experienced some of this market volatility, but also your opportunity there to request a copy of that income allocation book, or the easiest way, just pick up the phone right now and give a call, 800-640-2256, 800-640-2256. Now, Tim, it's not only that we experience a downturn, but how long these downturns typically and historically have lasted. They're not an overnight phenomenon. It's not down one day and right back up the next. It's that period in between that really can be harmful or fatal to a successful retirement.
Pete, that's a great point. Most people don't realize is that a bear market, takes about 18 months to finally settle down where you realize you were in it, which is pretty scary. It's, 1,000 paper cuts, death by 1,000 paper cuts, as they say. So it's a terrible, terrible way to go. And you're hoping for the best. You're hoping for the best. We talk about that a lot in our class, the psychology of emotions that you have during a bull market versus a bear market. It's very real, hesitancy, despondence, that type of thing in a bear market. But unfortunately, most people don't realize it. They say, it's going to come back someday. Well, why wait for that? If I'm in my 60s, I don't have that much time to be waiting on something to come back because I don't want to work that much longer. And you're trying to do things like get into a target date fund with maybe a 2025 in it, but those aren't silver bullets. You'll still take a loss. And that's why we harp on people in our classes or anyone I talk to who is over the age of 59 and a half, you are allowed to do in-service distributions, which will actually allow you to put your money into something that can be safe. It can be whatever you want it to be, but it'd be an IRA. There's no taxes on the move. What you're putting into your 401k every 2 weeks in your paycheck, the deferral stays the same. And guess what? The match by your company will stay the same as well. But the vested money that you have in there, if you're over 59 and a half, you can take the money out and do whatever you want with it. Again, no taxes, but you take more control of your own future.
So, Tim, inside most 401ks, the options are not wide and varied, and a lot of times not all that fantastic. A lot of those life cycle or target date funds, which during our younger years kind of automatic and out of sight and out of mind with a predetermined investment formula and probably reasonably decent for accumulation during those early working years. But as we get closer to that retirement time, can be very limiting and may not be the most appropriate options. So this age 59 and a half, a very important benchmark. Once again, just restating what you said right there is that at 59 and a half, most, if not all, financial plans, or 401k plans these days offer the opportunity for us to remove dollars from the 401k, take those and take personal control over them, roll them tax-free, no cost, tax-wise to an IRA, and then open up the spectrum of the financial world. We have so many additional choices and options that open up to us when we do that, and we can put in place things that may be more appropriate for a near retirement-minded individual, a saver investor. Oh, and by the way, you can continue contributions to that current 401k, continue capturing the match, continue making progress there. And on the grand scheme of things, Tim, money that you're not contributing to, previous dollars, when we undergo a downturn, they don't really benefit. But if we are contributing plus getting a match, downturns can actually be advantageous so long as a big lump sum, a big chunk of money is not just losing value in the midst of it.
Right. I mean, what you're speaking of dollar cost averaging, the market's lower, we're going to buy more. Yes, it's a great opportunity. Meanwhile, your other money is working harder for you in another IRA that you have control over or an advisor is helping you with that can actually make it great for you. So you're having the best of both worlds. You don't close out your 401k. Everything stays the status quo over there, but at the other side, you have some things in there that maybe can be uncorrelated, like annuities. The Secure Act 2.0 that they're talking about, they're going to add annuities to 401k platforms because people are looking for safety, and the guarantees that come with that. I mean, there's a reason that even the government sees through this. And I think most people that are listening to the radio show are smarter than the government in most cases. So this is a great opportunity for people. If you're over 59 and a half, give us a call and we can go through the exercise and see if it's something for you.
Now, Again, that number, 800-640-2256, 800-640-2256 to speak with a certified financial planning professional, Tim Stearns, CFP, about your specific situation, to go through that review, that analysis, that strategic strategy session for your financial future. Tim, you mentioned the Secure Act 2.0. One of the big pushes is including annuities inside of 401ks as an option. Now, that is a nod and a tip of the cap to the government's recognition that the American public probably would benefit from the opportunity for guaranteed lifetime income at the end of their working career. However, I've also heard that a lot of the annuities that are offered inside of 401k plans, or that may soon be offered as a result of that Secure Act 2.0, may require that we give up control and access to a portion of our money. And that's why we need to speak carefully with a financial advisor, qualified and experienced, because there may be options out there if we do take the step to take personal control and roll that money over, where we have the ability to generate that lifetime income without the requirement of giving up control of our lump sum and our life savings.
Right. And that's not how the annuities I'm speaking of work. We would have better opportunities over there that the person, the participant, I should say, has control over their money. And what that does is that, people like having control. They don't want to be in the harm's way and not be able to get out of it. So these are the things that we go through the exercise with people. An income allocation plan will help with that as well. It'll dictate exactly what, it's going to look like and where you're getting the money per month.
Once again, speaking with Tim Stearns, CFP. If you would like to have a conversation directly with Tim or attend one of those upcoming educational courses, the retirement rescue classes that Tim Stearns puts on throughout the area, throughout the year, pick up the phone, give a call, 800-640-2256. That's 800-640-2256. Tim, let's say we are leery of taking losses and worried about where the market may be heading. What are some of our options? What can a saver or investor do with their money that is an alternative where we still are going to have the opportunity for continued growth and progress?
There's a lot of great funds out there. Most of our clients are in institutional funds that will have stop losses in them. Are they guaranteed to not lose money? Of course not, but they will lose less than the rank and file mutual fund. Remember, with a mutual fund, 80 cents on a dollar, according to the Investment Company Act of 1940, has to stay invested in the market. Okay. Yes, you can call your 401k provider or go online and move your money into cash, but you will not get a phone call from them saying, hey, we're going to cash. So that is not a thing. With institutional platforms, we actually have the control to go all to cash if we see the market doing poorly. For example, in March of 20, when the pandemic started, the market went down over 24%. One of our money managers went to cash. And my mom was in that account, and she actually made 0.27%. And I will take that as a win all day long, because she did better than 24% to the south of that. So these are the things that we do differently. If people want active money management, that is what we do. We are not a buy and hold shop, because I don't think it works. In my career, the 27 years that I've been doing this, it's been kind of an up and down market. We're just talking about having a 13-year bull market, and we only made 5.8% for 21 years when people are touting 10 and 12%. Let's get real out there, and make sure that we understand what the market really entails.
Now, Tim, I want to throw this out there as we end the program, that another alternative, I-bonds, nearly risk-free, government-backed. For May, they announced a rate of 9.62%. This is guaranteed. It does have at least a next 6-month guarantee, and then the rates can change. There are some drawbacks, however, and some significant limitations. As individuals, we can't put more than $10,000 a year into that. But 9.62% government-backed and guaranteed, Tim, that does sound like a pretty attractive option and tool.
I agree. My mom has done that. And the problem we've had is that if you have any questions about your account, if you go to Treasury Direct, You try to reach a human being. She was on hold for an hour and a half at a time, and gave up. And she's 92 years old and retired. She can afford that time, as she says. I couldn't stand that. And go figure, somewhere that can earn us that much money, the government limits how much we can have, which is only $10,000. And I know most of the listeners I've met through this show have much more than that, and they're looking for better alternatives. And that's why they come to us.
And probably not a place to generate income from if you are specifically looking to do that, since there is a potential liquidity cost if you get out of them in a certain period of time before the end of 5 years. So a great alternative, but you do need to, as with any investment option, understand both the pros and the cons, but that is one place that you can get some safe growth right now with your money. And then, Tim, you've got a number of other options. If somebody has specific financial goals, you'll talk them through, whether it's for growth, whether it's for protection of principal, whether it's for generating income. As a certified financial planning professional, Tim Stearns, CFP, you've got access to the spectrum of the financial world and can find the right fit and solution to make sure dollars are working in somebody's favor and toward their goals.
I can't wait to help people. Give us a call. We'll go through all the different options and make sure that you're in the right investments. The big thing I will say is that, I feel like the first quarter of this year was a wake-up call, and we're going to see a lot more of that the next year, unfortunately, and it's time to make a move.
Yeah. And when the alarm goes off, hitting snooze doesn't really accomplish too much. The alarm will keep going off. You can keep ignoring it. That's not generally the recipe for success. When the alarm goes off, we do want to take action. And that's where you can take action, ladies and gentlemen, but you got to wake up first. You got to make sure that you understand where your money is, how it's invested, what risks you are exposed to, and as well, all alternatives that are out there that may help you achieve and accomplish your goals in a more successful manner. Pick up the phone, give Tim Stearns a call. That's what the certified financial planning professional is for, to help walk you through your options. And Tim is there as a resource for proactive Chicagoland area savers and investors. 800-640-2256. That's 800-640-2256. And also that book, Income Allocation, still a few copies available for this segment of the program. If you've got over 500,000 saved and you would like to understand the risks that we face in modern retirement and specifically how to address them, pick up the phone, give a call, request your copy of Income Allocation. 800-640-2256. Tim, as always, we appreciate the time, the discussion, the information, and the education that you provide here on Protect and Grow.
Peter, thanks for having me.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program on 890 WLS every Sunday at 11 a.m. and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.